What if I told you that AMC's most explosive quarter in over a century is actually the exact reason you should be worried? If you looked at AMC's latest numbers, you'd swear the ultimate fundamental turnaround had finally arrived. A massive 26.8% surge in a single day, fueled by record-breaking box office news. But here's the question nobody's asking. What if buying this stock right now, thinking it's a long-term value play, means you're walking directly into a trap? Welcome back to Kalvan Mateo, where we don't trade the headlines, we trade the truth. Today, this is the AMC setup every serious trader needs to see. We're not just skimming the surface, we're ripping apart the balance sheet, the options chain, and the hidden institutional positioning to show you why the obvious conclusion is dead wrong. Real quick, if you want breakdowns like this that go deeper than the surface, hit that like button and subscribe. It genuinely helps the channel grow. Now, let's get into it. To understand why this is a trap, we first have to look at exactly how the market reacted to the initial shock. On July 20th, the stock violently exploded, hitting $2.46 on a staggering 181 million shares traded. But almost immediately, that momentum hit a brick wall, settling back down to $2.28 just a few days later. So what's really happening here? We are currently trapped in a highly structured short-term accumulation zone. The market is digesting this extreme volatility, and right now, the stock is completely boxed in between a $2.50 ceiling and a $1.85 hard floor. That sounds like standard market chop, until you look at the fundamental illusion hiding underneath. Here is the ultimate valuation reality. AMC is not a buy and hold investment. Massive outstanding dilution and a crippling $3.91 billion debt load strictly cap its long-term enterprise value. But here's the paradox, and it's a big one. Recent debt restructuring guarantees their survival all the way through 2029. This entirely removes immediate bankruptcy risk, completely transforming the stock from a fundamental black hole into a highly volatile, catalyst-driven trading vehicle. In other words, operational survival enables technical trading even without real profitability on paper. And to see exactly what triggered this recent catalyst, we have to look at their record-breaking quarter. The top-line numbers are genuinely stunning. Driven by 4.3 million moviegoers flocking to see The Odyssey, AMC posted its highest quarterly revenue in 106 years. Let that sink in. $1.60 billion, up 14.2% year over year. Even more surprising, they delivered an adjusted earnings per share of positive 14 cents, handily crushing analyst estimates that were calling for a 6-cent loss. But before you get too bullish, ask yourself this. What if the very thing keeping this company alive is the same thing quietly destroying shareholder value? Because there's another layer to this survival story, and it comes at a massive cost. To stay alive, AMC executed a strategic debt restructuring. They completed a $200 million direct offering, deploying those funds to redeem $125.5 million in 2027 notes. This maneuver is absolutely crucial because it pushes their new major debt maturity wall all the way out to 2029. It yields about $7.7 million in annual interest savings, neutralizing near-term bankruptcy risk entirely. Here's where the story starts to get much more complicated and, frankly, a bit painful for long-term holders. Despite posting a massive $321.4 million in adjusted EBITDA, a jaw-dropping 69% increase, the company still posted a GAAP net loss of $11.4 million. Why? Because the structural erosion caused by interest payments on their $3.91 billion total debt load simply consumes all of the operating profits. Until operational revenue actually outpaces debt servicing costs, that fundamental valuation ceiling stays aggressively capped. And that brings us to the one issue investors actually care about most, the silent killer of shareholder value: unrelenting equity issuance. The company is quite literally surviving by taxing its own equity base. In just one single year, the weighted average diluted shares skyrocketed by 67%, moving from 433 million to $722 million, and the dilution risk isn't over. AMC is currently seeking shareholder approval to expand its 2024 equity incentive plan from 25 million to 50 million shares. So think about that. Could the very shares you're holding be worth less by the time you finish watching this video? This sets up a profound dichotomy between fundamental friction and actionable trading drivers. On one side, you have every fundamental reason to avoid the stock: a $3.91 billion debt load, 67% share dilution, and persistent net losses. But on the other side, you have powerful, actionable drivers for traders: a 50 and 200-day simple moving average golden cross, high-density options clustering, and robust box office momentum. It's a battle between two forces. The fundamentals say avoid, the technicals scream trade. So which side wins? Which leads perfectly into the biggest misconception currently driving retail sentiment. Let's talk about the MOAS, the mother of all short squeezes. Retail sentiment is extremely bullish right now, amplified by the inverse Kramer phenomenon. But here's the cold hard math. A forced short squeeze is mathematically unlikely. Short interest is only 52.94 million shares, representing just 5.96% of the float, with a days to cover ratio of a mere 0.9. So could a squeeze rocket this stock to the moon overnight? The numbers say almost certainly not. Any upward mobility from here will be driven by organic volume and momentum, not short covering. So if retail is holding for a squeeze that isn't coming, what is the smart money actually doing behind the scenes? Institutional positioning is completely fractured. We saw 112 institutions buy in, including big inflows from Barclays and UBS, while 86 sold, with massive outflows from Marshall Wace and Jane Street. But the standout metric here is insider conviction. CEO Adam Aron personally purchased 250,000 shares for over $344,000 on the open market. That raises his economic interest to over 12.3 million shares, signaling heavy executive confidence in the 2026 and 2027 film slates. That sounds like a green light, until you look at the hidden hedge warning buried deep in the options chain. Post-earnings, over 300,000 contracts were traded, 100,000 calls versus just 10,000 puts. There is massive open interest anchored strictly at the August 21st $2 and $2.50 call strikes. This creates a magnetic resistance ceiling. But here's the warning most people miss. While volume leans heavily toward calls, put premiums remain elevated. And what does that tell us? It tells us institutional investors are actively and aggressively hedging against post-earnings downside risk. The smart money is buying insurance, even while retail celebrates. This complex positioning explains why Wall Street analysts are suddenly shifting their tune. Post-earnings analyst sentiment is drifting toward neutral bullish. Citigroup remains a strict sell with a $1.20 target, but others are raising their numbers fast. Macquarie went to $2, Benchmark to $3, and Wedbush upgraded their target to $4, moving all the way to an outperform rating. However, despite all these upward revisions, the broader street consensus rating still remains a cautious hold. And that brings us to the actual chart, where a rare technical formation is drawing a hard line in the sand. The stock has formed a true golden cross, with the 50-day simple moving average crossing above the 200-day simple moving average. This establishes a firm structural floor at $1.88. Right now, the 14-day RSI is sitting between 51 and 56, which is perfectly neutral. It's neither overbought nor oversold. This $1.88 structural floor gives us an exact, data-driven parameter for risk management. So how do we synthesize all of this data into a single, actionable strategy? Here is your trade execution plan for the short term. Step 1. Accumulation. You can accumulate on weakness in the $2 to $2.12 zone, leveraging the 10-day EMA. Step 2. Momentum confirmation. Alternatively, Initiate a long position only upon a confirmed, high-volume 1-hour candle close above the severe $2.50 resistance wall. Step 3. Your targets. Primary take profit is $2.75, with a secondary target at $3. And Step 4. Ruthless risk management. You must set a strict stop loss at $1.85. A daily close below that $1.88 structural support completely invalidates the intermediate bullish trend. Now, before we wrap this up with the final verdict, I need to be completely transparent with you. Everything in this video is for educational and informational purposes only. I am not a licensed financial advisor, and this is not financial advice. Trading stocks, especially volatile ones like AMC, carries significant risk, and you could lose money. Always do your own research and consult with a qualified professional before making any investment decisions. Your money, your responsibility. With that said, here is our final verdict on this deeply controversial stock. Survival is secured, but profitability requires immense discipline. Bankruptcy concerns have been officially postponed to 2029, providing a clear runway for volatile, catalyst-driven upside. But let me be perfectly clear. Overwhelming debt and relentless dilution render traditional buy-and-hold strategies entirely invalid here. Adherence to the $1.88 support floor and the $2.50 breakout ceiling is absolutely mandatory for profitable execution. Watch the volume, watch the options flow, and always trade the chart, not the hype. So now I want to hear from you. Here's my question. If you had to choose right now, would you trade this AMC setup for the short-term volatility, or would you avoid it entirely because of that crushing debt load? Drop your answer in the comments below. I read every single one, and I genuinely want to know where you stand. If this breakdown gave you a clearer picture, smash that like button and subscribe to Kalvan Mateo so you never miss the setups that actually matter. I'll see you in the next one.